Welcome back to New Venture Mentor, your spot for straightforward advice to help you plan, launch, and grow your new startup or small business. I'm Kate Costa, and this week we're sticking with the summer reboot and doing a 5-minute finance lesson on the basics you need to know about your balance sheet. Since I work with first-time entrepreneurs who don't typically have any background in business management, I spend a lot of time talking with my clients about financial statements and getting them up to speed on what's what. Now, clearly nobody's going to become an accountant overnight, nor should you try to, but every business owner should have enough knowledge to be able to understand what your accountant is telling you about the financial state of your business and to be able to read basic financial statements yourself to get the pulse of your business's health. So, as one step towards that goal, I'm giving a series of 3 5-minute finance lessons to give you a brief overview of the 3 basic financial statements: the income statement, the statement of cash flows, and the balance sheet. This week, we're covering the balance sheet. The balance sheet gives a picture of a company's assets, liabilities, and shareholders' equity, i.e. what the company owns, owes, and who owns it at a specific point in time. It's a static picture and it will be dated accordingly. Company X balance sheet as of December 31st, 2015, for example. The balance sheet is based on the following equation: assets equal liabilities plus shareholders' equity. The 2 sides of that equation must always equal each other. So once you start building your financial statements, you need to double check that the equation balances. If it doesn't, you know you've made a mistake somewhere. Think of it like this: everything that the company owns, which are its assets, had to be paid for somehow. And companies pay for things by either borrowing money, which would be liabilities, or getting the money from shareholders, which would be shareholders' equity. When you look at the balance sheet in this way, it's easy to understand, firstly, why it must always balance, and secondly, what should go where. The exact items that will be on a balance sheet differ from industry to industry and company to company. However, there are some basics that will show up on almost every company's balance sheet. On the asset side, you should include items like cash and cash equivalents, accounts receivable, inventory, property, etc. Additionally, assets are broken down into current assets and long-term assets. Current assets are those assets that are considered most liquid, meaning that they're either cash or can be exchanged for cash quickly and that they might come and go quickly. Long-term assets are those that have monetary value, but that cannot be exchanged for cash as readily, and they tend to be held for longer periods of time. For example, accounts receivable would be included under current assets because you can either collect the payment from those who owe you or sell it to a factoring or collections company almost immediately and have access to that cash. Additionally, the balance of your accounts receivable is constantly changing. An office building owned by the company, on the other hand, would be included under long-term assets because you can't convert its value into cash so readily, and you'll likely continue to see it on the balance sheet for years to come. Putting the building up for sale, finding a buyer, negotiating the terms, closing, collecting payment, and transferring title will take a significant amount of time, so this asset is considered illiquid and long-term. On the liabilities and shareholders' equity side, you'll also break liabilities down into current versus long-term debt. Current debt is that which must be paid within 1 calendar year of the date of the balance sheet. Long-term debt is debt which will be due more than 1 calendar year from the date of the balance sheet. For example, if your company has a mortgage on that office building that we discussed above, the amount owed on the mortgage for the next 12 months would be listed in current liabilities, while the amount that will be owed on the mortgage after those 12 months will be listed in long-term debts. In addition to the current and long-term debts, this section of the balance sheet also lists shareholders' equity. Let's go ahead and take a look at an example to help you understand. That's it for this week here on New Venture Mentor. I hope you found this video helpful, and I would greatly appreciate you sharing it with a friend or colleague if you did. Also, Don't forget to get over to katecosta.com if you're not already there and sign up for my free email newsletter so you'll never miss the latest tips and info to help you plan, launch, and grow your new startup or small business.